Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with the topic Ind AS 103, that is business combination. This is the second lecture on business combination. So friends, let me remind you what we have learnt in the first lecture. In the first lecture, you have learned the meaning of the term business combination and prerequisites of what is a business combination or what a business combination could be. So try to recall what is the precondition for a transaction to be called a business combination. There is a transaction in which the acquirer obtains control over the acquiree, and that acquiree has to be a business. So what you are acquiring, if it is business, then it will be considered as a business combination. However, what you are acquiring, if that is simply a single asset or a group of assets but not a business, then it goes out of the scope of this standard, that is Ind AS 103. So friends, it is very important for you to identify whether in a given situation there is a business combination or not. This is what we have learnt in the previous class. In this class, we are going to start our discussion with this point, that is accounting for asset acquisition. So what would happen if what is acquired is not a business but simply a single asset or group of assets? That means what is acquired is either a single asset or a group of assets, but definitely not the entire business. Then we cannot call it as a business combination. We will refer to it as asset acquisition, and what we are trying to do is learn the accounting for asset acquisition. So in the scope paragraph of Ind AS 103, it is clearly mentioned that this standard, that is Ind AS 103, shall not apply on asset acquisition. However, a simple guidance is definitely provided, and as per that guidance, within that same scope paragraph, you would find that the acquisition of assets will always be based on the fair value. So if you have acquired multiple assets and you have paid some lump sum consideration, in that case, whatever consideration you have paid, that must be allocated over the various assets, and the basis of allocation should be the relative fair value of these individual identifiable assets that you have acquired. So I repeat, if it is a single asset acquisition, then whatever be fair value of that asset, it will be recognized at that. However, if the amount of consideration what you have paid is different, then whatever consideration you are paying in cash will be considered as the cost of the asset, or will be considered as the implied fair value of the asset acquired. So when you are acquiring multiple assets, a group of assets which is not constituting a business, just acquisition of a group of assets, in that case whatever consideration you have paid in cash shall be allocated over these assets in the ratio of their relative fair values. Now, problem would arise when you have acquired this group of assets not by paying cash but by giving away other assets. In that case, it would be considered as acquisition of asset in exchange of assets, which will fall under the purview of Ind AS 16, that is property, plant and equipment. So conceptually what you have learnt over there will have to be applied over here. What you have learnt over there, that you will consider the transaction price as the fair value of assets given away, unless the fair value of assets acquired is more clearly evident or gives more reliable basis of fair value. So whatever gives you more reliable basis of fair value, you are going to consider that. Now we can talk like this, but this talking will not help you to get the concepts clarified. So let us do one thing. Let us take up certain examples which can clarify this whole discussion, and let us begin with one of the very important questions over here. Let us take up question number 8. let us read this question. NJ Limited acquires the following assets from EAP Limited. Now you can see one thing, list of assets given to you as per the records of EAP Limited, and what is given is the carrying amount in the books of EAP Limited and fair value of these assets. Because NJ Limited acquires all these assets, NJ Limited is the acquirer and the EAP Limited will be acquiree, or you can say seller of these assets. So carrying amounts in the books of seller and fair values of these assets have been given. NJ Limited paid a lump sum consideration of rupees 68 lakhs to EAP Limited in exchange for these assets. How should the transaction, that is the acquisition transaction, be accounted for by NJ Limited? Point number 1, we don't find any acquisition of business. It is simply acquisition of assets only. In the previous class, we have learnt that if there is acquisition of assets only, then it does not constitute as a business combination. If it is not a business combination, Ind AS 103 shall not apply on the same. So what you have to do in this case, you have to just identify one thing, that this overall consideration, the lump sum consideration paid for all these assets jointly, shall be allocated among these assets. Nothing to do with these carrying amounts, but the allocation will be on the basis of the relative fair value of these assets. Though Ind AS 103 does not apply on this situation, but what should be done in this scenario has been mentioned in one of the clauses in the scope paragraph of the standard. So let us see how to write up the answer. Ind AS 103 does not apply to the acquisition of an asset or a group of assets that does not constitute a business. In such cases, as per para 2b, the acquirer shall identify and recognize the individual identifiable assets acquired. The overall consideration shall be allocated to the individual identifiable assets on the basis of their relative fair values at the date of purchase. Such a transaction does not give rise to any goodwill or capital reserve. Let us move ahead and make that allocation as per the relative fair values of the assets given. So we would write the lump sum consideration of rupees 68 lakhs shall be allocated over the assets in the following manner. Buildings, 45 lakhs divided by 85 lakhs into 68 lakhs. Let me explain this calculation. 45 lakhs is the fair value of the building and 85 lakhs is the aggregate fair value of the individual identifiable assets. You could have seen one thing, 85 lakhs given in the question as the total of the individual fair value of all these identifiable assets. So individual fair value divided by total fair value into the amount of consideration will give you the amount of consideration that will be allocated towards building. So for the acquirer, the measurement of this asset building will be made at rupees 36 lakhs. Similarly, you will make calculations for other assets. So exact same way of making the calculation for each of the assets. Basically, we are allocating the overall consideration of rupees 68 lakhs over these 4 assets in the ratio of their relative fair values, which were 45 lakhs, 22 lakhs, 6 lakhs and 12 lakhs. So you can see one thing, it is the amount of 68 lakhs which has been allocated over these 4 assets in the ratio of 45, 22, 6 and 12, and that is why the aggregate of these 4 fair values comes to 85 lakhs, which becomes the base in all these calculations. So finally what we conclude is that these are the values of assets to be initially measured by NJ Limited with respect to acquisition of these assets. Let us move ahead and now talk about accounting for business combinations. Now friends, in order to understand the entire accounting of business combination, you should first recall the meaning of the term business combination. So if you can recollect, in the previous class we had been talking about what is business combination. When we started this class, here also we have talked about what is business combination. Let me once again mention the definition of business combination. Business combination is a transaction in which the acquirer obtains control over another business. So we are talking about a situation where the acquirer must obtain control. So first precondition is acquiring control or obtaining control. Second condition is the control has to be obtained on any business, not on an individual asset or simply group of asset. It has to be a business. The acquiree has to be business. So friends, if the first precondition is to obtain control, the question arises, how can you obtain control over another business? Two typical ways. One is by taking over the business itself. Once you take over the business, you can manage it the way you want. So for that, you have to acquire all assets and liabilities, all the processes. You remember meaning of business? Input, process and output. These three constitute a business. So if you want to acquire a business, you have to acquire not only assets, but along with the assets, the processes as well. Once you have inputs and processes, obviously it will generate output in some or the other form which can generate revenue for the entity. These things we have discussed in the previous class. So friends, one mode of obtaining control over a business is to simply acquire the business itself. Now I am talking about another mode of acquiring or obtaining control. Another mode of obtaining control could be having stake in the majority voting power. In simple words, owning more than 50% of equity capital of that other business. If you can own more than 50% of equity capital of another business, you are by default considered to control that other business. So control can be obtained either by acquiring the business itself or by investing into more than 50% of its equity. So friends, if it is more than 50% of its equity or there are some other criteria to establish control, we are going to learn that later in the chapter Consolidated Financial Statements. But here one thing that you should know very clearly, that if there is more than 50% of another company's equity that you are owning, you are considered to control that other company and that other company becomes your subsidiary. Now friends, the moment this kind of acquisition takes place, that means acquisition of shares, not acquisition of business. So this is basically acquisition of shares, but this acquisition comes under the category of business combination because you are fulfilling the definition of business combination, you are obtaining control over that other company. So friends, let me give you a small example. Suppose there are two companies, X Limited and Y Limited, and X Limited acquires equity shares in Y Limited to such an extent that it amounts to 70% of total equity of Y Limited is now held by X Limited. In other words, X Limited owns 70% of voting right in Y Limited. So Y Limited becomes the subsidiary of X Limited and X Limited is the parent company, or you can even call it a holding company, which is considered to have control over its subsidiary. Now friends, whenever it is a holding subsidiary relationship, not just Ind AS 103, but there is another standard, that is Consolidated Financial Statements, Ind AS 110, which also comes into picture. In fact, that other standard has to play a bigger part. This standard will also play its part. So you should be very clear about one thing: in the scenario of shares acquisition, it is not simply Ind AS 103 that will apply. Parallelly, two standards will apply, Ind AS 103 as well as Ind AS 110. In fact, the scope of Ind AS 110 in a scenario like this requires application of Ind AS 103 for certain particular calculations. Let me mention what are those calculations. So, when you acquire a business by paying some consideration, there may be some difference that may arise, and what you have learnt in intermediate, that when you are acquiring a business and settling the consideration, if the consideration amount is different from the value of net assets acquired, that difference can either be considered as goodwill arising on acquisition or a capital reserve that is arising on acquisition. So basically, if it is a business acquisition or a business combination, goodwill or capital reserve can arise if there is difference between the fair value of net assets acquired and the amount of consideration settled. However, when there is such goodwill or capital reserve which may arise in that type of acquisition which we are considering as not acquisition of net assets but only and only acquisition of shares. So, let me get back to the holding subsidiary example where we have taken X Limited as the holding company, Y Limited was the subsidiary. X holds 70% of equity capital in Y, and in such cases we have seen one thing, that X obtains control over Y. So obviously, to acquire these shares, X Limited must have settled some consideration. If X has paid a certain amount and that consideration amount is different from the fair value of the assets or fair value of the shares acquired, then definitely what will happen is there will be some difference. How to determine that difference and how to recognize that is to be dealt with under Ind AS 103. Let me put it in a crystal clear words. When there is acquisition of shares in another company, that means X Limited acquires 70% of equity capital of Y Limited, X Limited obtains control, one thing done. Now when control is obtained over a business, there is a business combination. Parallelly, two standards will come into picture, Ind AS 103 as well as Ind AS 110. What is the role of Ind AS 103? On that acquisition of shares, how much is the goodwill or capital reserve arising, that will be measured as per the requirement of Ind AS 103. Secondly, I was just explaining you one small thing, that if X Limited holds 70% shares in Y Limited, then X Limited is considered as the parent company and the remaining 30% share capital of Y Limited is held by some other shareholder, which will be considered as a minority interest, which technically is known as a non-controlling interest. So how much will be the value of that non-controlling interest arising on the date of acquisition? Even that has to be determined as per the requirements of Ind AS 103. Once this initial measurement part is done, later on the consolidation procedure will be followed as per the requirements of Ind AS 110. But initially at the acquisition date, the application of Ind AS 103 becomes a mandate with respect to determining goodwill or capital reserve that arises on that acquisition, and secondly for determining the amount of non-controlling interest or the value of that non-controlling interest. So friends, whatever I have discussed, let me substantiate that, let me put it in more and more simple words for you to understand and even note down these important things. So please pay attention on the screen, I shall do the needful. So friends, we have already mentioned what is the meaning of business combination. A business combination is a transaction in which the acquirer obtains control of another business. So we have two companies, X Limited and Y Limited, into the picture, where X Limited acquires 70% of equity in Y Limited and settles the consideration in cash. So what happens after this acquisition transaction? After this transaction, Y Limited becomes a subsidiary of X Limited, as per Ind AS 110, that is consolidated financial statements, determining the goodwill arising on acquisition shall be in accordance with Ind AS 103, that is business combination. Let us move ahead and write some more notes which are very important. In respect of consolidated financial statements, the following calculations will be in accordance with Ind AS 103, that is business combination. One is goodwill arising on acquisition and another is non-controlling interest, that is NCI, as on the date of acquisition. However, subsequently the preparation and presentation of consolidated financial statements, including the consolidation procedures, shall be done in accordance with Ind AS 110, that is consolidated financial statements. Let us move ahead and now talk about the acquisition method. It is basically a systematic step-by-step approach for recognition and measurement of certain items of accounting that would arise at the date of acquisition. So friends, what exactly is required by this acquisition method? It is basically comprising of 4 steps. The first step is identification of the acquirer. Means any situation of business combination, who is the acquirer or who is the acquiring entity has to be first decided. Unless you decide that, you will not be able to proceed ahead. Now in this regard, you might be wondering that what is the crux about who is the acquirer. It can be very simply identified. If A takes over B, it is A who is the acquirer. But my friends, this may not be so simple in all the circumstances, as and when we are going to discuss those situations where identification of acquirer in a given scenario could become a big question mark, you will understand what exactly this step is requiring you to do and why we are putting these in a step-by-step manner. The first step being most important step, that is identification of the acquirer. The second step over there is identification of the acquisition date. So there may be various dates at which the negotiations take place between the acquirer and acquiree. There may be negotiations after negotiations, there will be a final point of agreement, then there will be disbursement. All these events will happen at different dates. Which should be the date of acquisition? You need to consider that. You need to even consider that date of acquisition, because all the accounting has to start with the date of acquisition. So the first step, as I told you, is the identification of the acquiring company. Second step is the identification of acquisition date. Third step is about recognition and measurement at the acquisition date. So to be more specific, recognition and measurement of what? Number 1, the assets that you have acquired or assets on which you have established control. Second, the liabilities that you have assumed. Third, if there is any non-controlling interest that is arising at the date of acquisition, determining the amount of the same. So recognition and measurement of 3 typical items: assets acquired, liabilities assumed, and non-controlling interest, if any, that arises on the date of acquisition. And fourth step will be to determine the amount of any goodwill or gain that arises on this acquisition. So general notion is what? If you have paid something in excess, that excess is considered as a payment towards the goodwill, and if there is any short payment, it is considered as a gain on bargain purchase. So I repeat again the technical term, gain on bargain purchase, and which is generally transferred to capital reserve. So friends, just let me quickly remind you what are these 4 steps that we have to apply. Number 1, it is the identification of acquirer. Number 2, identification of acquisition date. Number 3, recognition and measurement of various accounting items like assets acquired, liabilities assumed, and any amount of non-controlling interest if it arises on the date of acquisition. And fourth and last step is determining the amount of goodwill or gain that may arise on the bargain purchase. So as we have discussed, Ind AS 103 requires application of acquisition method. The following key steps are involved in the acquisition method for business combinations. First step is identifying the acquirer. Second step, determining the acquisition date. Third step, recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. And step 4 is recognizing and measuring goodwill or a gain from a bargain purchase. Let us write some more notes before I provide any further explanation. Identifying acquiring enterprise. All business combinations within the scope of Ind AS 103 are accounted under acquisition method. For this purpose, the parties involved have to identify the acquirer. The acquirer is the entity that obtains control of another entity. The another entity on whom the control is established is termed as acquiree. This is because the acquiree's assets and liabilities are the subject matter for recognition and measurement principles of the standard. Alright friends, you would have finished writing this whole thing. Let me now explain everything about this first step that you are going to perform, that is identification of the acquirer or identification of the acquiring entity. Friends, please try to recall the earlier part of this lecture when we started discussing the accounting for business combination. I have explained you two different ways through which an entity can establish control over another entity. Try to recall that. One is by acquiring the net assets of that other entity. Another is by acquiring the equity interest of the other. That means either you can directly purchase the assets and liabilities and the processes of that other business, so you are acquiring the business itself. Another mode of acquisition could be not by buying the assets and liabilities of that company, but buying its equity. So much of equity that you start establishing control over that another entity. In simple words, buying the majority of that company's equity share capital. Now, in either case, we will be considered as acquirer because we are acquiring. But here I told you there can be some different type of scenarios where you need to place lot of caution while deciding who is the acquirer. So for making this thing simplified, let me classify this whole discussion into two categories. First category, where I am a company and I am acquiring the business of another company and I am settling the consideration by all means other than my own equity. That means in the first category, I am not giving my own equity shares, I am not issuing my own equity shares. In that case, the picture is crystal clear. Because I am not allowing anyone to participate in my equity, nobody is going to control me. If I am acquiring somebody's business, I become the controlling entity. Put an end to the matter. That means if I am acquiring somebody's business or somebody's majority equity capital and I am settling the consideration by any means other than my own equity, definitely I am the acquirer. So we will be talking about this first category where the consideration can be settled either in cash or in exchange of other assets, means I can give other assets, or third, it can be by assuming liabilities like issuing debentures or any kind of debt securities of my company. So friends, in the first category of this discussion, we are talking about situations where the settlement of consideration is done in any mode, in any means other than the equity of the acquiring company. So equity capital of acquiring company remains undisturbed as it is. So friends, in such cases, in all the situations you will find that the company that is acquiring the net assets or the equity of the other becomes the acquirer. I will give you this by lots of examples one by one, And I'll give you a small note also about this right now on the screen. Please pay attention. So friends, as I have mentioned in the first category, acquisition through settlements other than equity in a business combination effected primarily by transferring cash or by transferring other assets or by incurring liabilities, the acquirer is usually the entity that transfers the cash or other assets or incurs the liabilities. Alright friends, you would have finished writing this note. Let me now give you some examples in this regard. So consider the fact that there are two companies, X Limited and Y Limited. X Limited acquires the net assets of Y Limited and the consideration is settled in cash. In such case, clearly X Limited is the acquirer. Another example, X Limited and Y Limited are the two companies. X Limited acquires net assets of Y Limited and consideration is settled by transferring a land which was owned by X Limited. Even in this case, X Limited is the acquirer. Let me take you ahead and give you some more examples. X Limited and Y Limited are two companies. X Limited acquires net assets of Y Limited and the consideration is being settled by issuing 30,000 debentures in X Limited. Clearly, X Limited is the acquirer. X Limited and Y Limited are two companies. X Limited acquires 70% of equity in Y Limited. That means this time X Limited is not acquiring Y Limited's net assets. It is instead acquiring the equity capital of Y Limited and the consideration is settled in cash. Now see what is happening. Through this transaction, X Limited becomes a majority shareholder in Y Limited. In other words, Y Limited becomes the subsidiary of X Limited and it is X Limited that is establishing control over Y Limited. So from the viewpoint of Ind AS 103, X Limited is definitely the acquirer. Let us move ahead and now talk about the next category, that is acquisition through issue of equity instruments. In a business combination effected primarily by exchanging equity interests, the acquirer is usually the entity that issues its equity interests. However, in some business combinations, commonly called reverse acquisitions, the issuing entity is the acquiree. Let us now discuss about this second category where acquisition is done and settlement is made through issuing own equity. Let me substantiate this by giving examples. So friends, assume that in a business combination scenario, I am X Limited, you are Y Limited. So two of us are involved in this transaction. I am X Limited, you are Y Limited. I am acquiring your business, and because I have acquired something from you in the form of consideration, I have to give you something, right? And to settle that consideration, this time I am issuing my own equity shares. After the whole transaction is complete, I am the acquirer generally, but now you will look into one thing, that because I have given you my equity shares, you become one of the equity shareholder in my company, that is X Limited. So you are Y Limited. After the transaction, you become one of the shareholder of X Limited. I will simply ask you to find out what proportion of shares are you holding in X Limited after the acquisition is complete. If the percentage of shareholding that is in your hand is some 20-30% or something less than 50%, no problem. You don't control me in that case. That means X Limited continues to be called as acquirer because it is X Limited which will be exercising control over the entire combined business. However, in a typical scenario, there may be a different situation. For example, same thing, I am X Limited, you are Y Limited. I have acquired all your business, your complete business is now acquired by me. That means I had my own business plus I have acquired your business as well. But this time when I am settling the consideration to Y Limited, I am issuing my own equity shares to Y Limited. But this time I have issued so many equity shares to Y Limited that Y Limited becomes 80% shareholder of X Limited after the completion of this acquisition deal. In other words, after this all business combination is done, we find that Y Limited is 80% stakeholder in X Limited. How can now you say that X Limited controls Y Limited? Don't you think that it will be a reverse scenario where Y Limited will start controlling X Limited, because Y Limited has become the parent company of X Limited. As a result, even though X Limited has acquired business of Y Limited, but because of the type of consideration settlement, it is Y Limited that finally establishes control over this combined entity, and Y Limited becomes the acquirer. Now friends, very important point to be discussed over here. Legally, X Limited will still be acquirer. I repeat, legally X Limited will still be acquirer, because in legal terms it is X Limited which has taken over the business of Y Limited. Legally it will be X Limited which is the acquirer. However, from accounting viewpoint, Ind AS 103 requires you to consider Y Limited in this situation as the acquirer. We will better call it as accounting acquirer, means acquirer from the viewpoint of accounting and acquirer from the viewpoint of legal reporting. Both will be different entities. So in all earlier scenarios, acquirer who is a legal acquirer or acquirer from the accounting viewpoint, both were same. This time in my example, what I have just given to you, Y Limited is the accounting acquirer as per Ind AS 103, but X Limited continues to be the legal acquirer. So friends, I want you all to understand this whole matter with a proper given example and a note following the same. So I will be presenting the same on the screen. Please take note of that. So friends, I am taking the same example of two companies, X Limited and Y Limited, where X Limited acquires the net assets of Y Limited and the consideration is settled by issuing 80,000 equity shares in X Limited. Another information that is given to you is that prior to acquisition there were 20,000 equity shares in X Limited. So you can see one thing, original 20,000 equity shares in X Limited plus the new shares which are issued, that is 80,000 shares issued to Y Limited, overall it becomes 1 lakh equity shares in X Limited, out of which 80,000 shares are held by Y Limited. So we can say after acquisition Y Limited holds 80% of equity in X Limited. So Y Limited is the acquirer from the viewpoint of Ind AS 103, and therefore we would call this company as accounting acquirer. On the other side, X Limited continues to be the acquirer from legal point of view and therefore termed as legal acquirer. So friends, here because we are talking about Ind AS 103, from the viewpoint of Ind AS 103, Y Limited will be the acquirer. Don't forget that. So that is, throughout the standard what we need to consider is the accounting acquirer as the acquirer. We will consider the other entity as the acquiree. Now let me talk something very important about this kind of situation. You will have to exercise a lot of cautions when you are dealing with a situation like this, because in examination the question may ask you to identify the acquirer. Now look into one thing, which type of acquirer the question is asking. If the question is silent, by default it is considered that the question is being asked from the viewpoint of Ind AS 103. That means they are talking about accounting acquirer, and therefore be clear while writing up your answers. If the question is specific, there is no problem. If the question is silent, it is implied that the question is asking from the viewpoint of Ind AS 103. So they are asking you who is acquirer in terms of who is accounting acquirer. And in the worst case scenario, if you are not clear with what has to be done, I would say mention both, that is mention who is the accounting acquirer and who is the legal acquirer. But in 99.9% cases, questions in examination will ask you who is acquirer from the viewpoint of Ind AS 103. You will always call the accounting acquirer as acquirer from the viewpoint of Ind AS 103.